Hey, good morning. It's Dan Moorhead. Thanks so much for joining this call. Talk about our new blockchain fund. We have the whole investment team on with me, and many of whom will be speaking, but all of whom are available to answer questions. So use the Q&A box if you have questions. Particularly on the blockchain fund, but really anything on crypto. Love to help spur the dialogue and enhance education in the community. So feel free to ask questions as we go. We'll answer them real time, and then happy to stay on the call after the end of the prepared remarks to keep answering questions to make sure we get to everybody's. It's actually an absolutely fascinating time to be in crypto. Our firm's been in the space for 8 years. It's been interesting all along this, but now crypto is even part of the United States infrastructure bill that is being debated in the House and Senate right now. Actually got a call from a senator over the weekend to ask what we thought should go into the bill, which is a mind-boggling change for our industry. So we have a packed agenda. We have a lot we want to cover and talk about. So we'll kind of rip through a handful of big thoughts on the market itself and why blockchain is important. Specifically, what we see as the opportunity right now, and then go into investing in the space and the fund itself. The firm, for those of you who don't know, many of you are LPs, but many of you are new to Pantera. Was founded after I left Tiger Management in 2003. We managed $1 billion in normal hedge funds at the time. But in 2011, I got introduced to Bitcoin, and it took a year or two to get my head around it, but ultimately came to believe it was going to be the biggest disruption of this generation, and that it should be a very large position. So we launched the first cryptocurrency fund in the United States in 2013, and now manage $4 billion across a multitude of different funds. We have four main strategies. Each one's mutually exclusive from the others, and we've invested in bubbles at the absolute high. Our Bitcoin fund launched 8 years ago at the low of the last 9 years. So we kind of caught all the ups and the downs. And the average IRR, this is actually a typo on the screen, the average IRR is 104% across all of those different cycles. And that's essentially the best advertisement for why to have some exposure to the space is in 8 different funds, eight different years, all kinds of crazy ups and downs. It can returns that are much, much different than you can get in normal assets. And again, I wanted to go to the next slide and highlight just kind of how we got here. After launching the first cryptocurrency fund, we also launched the first blockchain venture fund. And then my partner, Joey Krug, who is our co-CIO, did the first app on Ethereum. And in 2017, we did the first exclusively early stage token fund. So that gave us with 4 separate funds, and that historical legacy is great for some investors. Some investors want very specific exposure, and then also want to have the liquidity that we pass through of the underlying asset. And our Bitcoin fund is daily liquidity with 0 lockup. So you can come in on a Monday and come out on a Tuesday if you want. Our hedge funds are quarterly liquidity. So you're not making a very long commitment to the space. Our liquid token fund is quarterly with only 65 days notice, and then our early stage token fund is quarterly with 12 months notice. So there is a little bit of thought there. But then it leaves investors that want essentially to allocate to the blockchain asset class as a whole, with the option of buying into all 4 of our funds and creating their own version of it. But on the next slide, we have a graphic of our new blockchain fund. It's essentially a wrapper for all of the different types of assets that we currently trade. So LPs will get exposure to the entire blockchain ecosystem. And it has a couple of big advantages. One is we can kind of flow with the pendulum that swings back and forth between value. Sometimes tokens are really cheap relative to venture, and sometimes venture is cheap relative to tokens. And over the last 3 months, we've seen a great example of this. The value of tokens can reset very, very quickly, and they did reset down 55% from the highs in April and May, whereas venture is very slow moving. That term sheets from 3 or 4 months ago are still being executed. Entrepreneurs are still looking for the prices they earned 3 or 4 months ago. And so venture resets over a period of, say, 6 to 9 months. And that allows a fund like this that can trade all of the different types of assets to grab that opportunity and get invested. And then when the value of tokens might be rich or very expensive to venture, then we can transition into illiquid things like venture and early stage tokens. And with that, I want to hand it over to my partner, Joey Krug, to talk about why we think blockchain is so important.
Thanks, Dan. So at a high level, the way I describe our thesis is that we think that similar to how the internet was the beginning of a new information infrastructure, it changed not only how information was consumed, but also how it was created, basically democratized access to basically being your own media person. Like you publish content, you can be your own publisher at the internet. Crypto is doing the same thing, but for finance. So if you look at what's happening in DeFi, people are creating these kind of bespoke, custom new financial products all the time. There's a huge level of innovation that's happening in that area, and that's predominantly what we're looking to invest in. And so if you look at the history of protocols throughout time, when Bitcoin came out, it enabled global transacting, so sending money from one person to another globally at pretty low fees in 10 minutes to an hour. And it also solved this problem of the double spend problem. How do you make sure people don't spend the same money twice, or counterfeiting basically? How do you avoid counterfeiting when you have digital currency? So that was the problem that Bitcoin solved. Then with Ethereum, someone had the idea, Vitalik had the idea, why don't you have programmable money? So Bitcoin just lets you send money from one person to the other, but it doesn't let you program it. There's not really a whole lot that you can do with it with Bitcoin. With Ethereum, you can actually add, conditions around sending money around. So you can say things like, if this is true, this money goes to this person. If it's false, it goes to this other person. You can also create, any sort of financial contract, a trade, a swap, a bet, insurance, anything you can really think of, lending, all exists on top of Ethereum. The only problem with Ethereum is that it's not super scalable. So Ethereum itself does, roughly 20 transactions a second, depending on what type of transaction you're doing. And, finance does thousands per second. And so that's what we need to get to long-term if this is going to succeed. And so there's a bunch of different approaches towards doing that. One is Ethereum's own Ethereum 2.0 project to basically scale Ethereum using things like sharding and this tech called rollups. Another is something like Polkadot, which is another blockchain built by the former CTO of Ethereum, which is much more kind of scalable from day one. And so if you look at what things people are building in this sort of new parallel decentralized financial system, we think there's really kind of 5 main components of any financial system. And then there's obviously a lot of things that get built around those 5 components. But the 5 things are a unit of account. So you need some sort of stable currency to denominate commerce in or trade. And globally today, that's basically the dollar. Days that was Bitcoin. At this point, actually, most people in crypto are trading against stable coins. So they're trading against things like USDC, Tether, DAI, basically things that are pegged to the US dollar. Exchange-wise, you have decentralized exchanges that allow you to trade assets with no middlemen. So things like Uniswap lets you trade, ETH for USDC, or USDC for MakerDAO, and they let you do this in a way where there's no middlemen. It's much cheaper, and often there's actually much more liquidity. There's some days where there's more liquidity on Uniswap for ETH USDC than there is even on large exchanges like Coinbase or Kraken, et cetera. The last 3 are lending and issuance. So you need debt. You need to be able to borrow and lend. Protocols like MakerDAO, Compound, Aave enable this. Nobody's really figured out how to do uncollateralized loans yet, but I think that'll eventually happen as well. And then the last 2 components are margin and leverage. Margin and leverage are pretty widely used in DeFi at this point. I remember a couple of years ago when we had talked about this slide, we'd say, margin and leverage is a very hard problem. Nobody's really solved it or figured it out how to do it in DeFi. I'd say at this point, it's mostly been figured out. especially as the space has started to scale. It's much easier to do things like liquidations if someone's position starts to get close to being underwater in a system where there's scalability versus a system where it takes 30 seconds for a transaction to go through. And so now that things are migrating to layer twos, you see pretty sophisticated margin and leverage systems live in DeFi today. You have things like Perpetual Protocol, things like DYDX that let you basically go long or short assets like Ethereum. And they do it in a way where you can do it on leverage and basically on margin. And if it starts to drop, your position gets liquidated, and that market's actually pretty efficient at this point. But in the old days, it was much more difficult to do. And so if you look at the DeFi ecosystem, you basically have a few different layers. If you think of tech in general, people always talk about the stack. What does that really mean? Well, it's just like literally a stack of different pieces of technology that all kind of interact with each other, all the way up to the very top is the thing the user sees, and the very bottom is something that only really developers see. And so at the very bottom, you have blockchains themselves, Polkadot, Ethereum, Near, Cosmos, Bitcoin. Then one layer up from that, you have kind of critical infrastructure, things like oracles that get you data about the real world into the blockchain. One layer up from that, you have other protocols, things like lending protocols, decentralized exchanges that we talked about. There's also other types of protocols, things like protocols for synthetic assets, things like Mirror, which basically let you speculate on the value of things like the price of Tesla or the price of Google or the price of the yen, things like that. And they're purely synthetic, they're cash settled, and there's a protocol for that. If you go a layer up above that, you have other exchanges that kind of do similar things, that have sort of more kind of a user-focused UI. And then at the very top, you have what are called aggregators. So if you think of something like Uniswap, some users go to uniswap.org and go to use the UI and actually use Uniswap directly. But other users use it through what's called an aggregator. And that might be something like 1inch or Matcha, where you go to their site and you say, I want to trade 1,000 USDC and buy ETH. So I want to buy $1,000 worth of ETH. And what they'll do is they'll route it across all the decentralized exchanges to get you the best price, the best execution, like a broker would in traditional finance. And so those users may end up using Uniswap, but they're not actually going to Uniswap directly. I think long-term, that's how most usage in the space will happen. They'll go through aggregators, they'll go through wallets, they won't go direct to the protocols. And then if you look at DeFi itself, it's a really rapidly growing market. There's two kind of main metrics that I think are good for tracking the space at a very high level. One is value locked in DeFi. The way to think about this is basically just how much capital is in this new financial system. And in January 2020, it was somewhere a bit under $1 billion, basically rounded down. This year, August or so of 2021, it's a bit over $115 billion. Then the other metric is to look at trading volume of decentralized exchanges. So how much trading is happening in this new financial system? And again, in January 2020, it was about $1 billion a month. Last month in July, it was about 56 billion. It's come off a bit after the big run up in prices and volatility back in May. But overall, the growth is still really sizable, basically 56x from January 2020 until now. And with that, Paul's going to talk about some other areas of focus for the fund.
Thanks, Joey. So I'll talk about a few different areas that we've invested into, starting with infrastructure. This is probably the hottest area that most VCs and traditional growth VCs are looking at right now. Basically, traditional equity investments that are providing services for consumers or institutions or developers to get into the space. And especially on the developer infrastructure side, we led the Series A in Alchemy, and I'm on the board. Alchemy provides nodes as a service, or basically helping developers run their servers to be able to interact with the blockchain and create the blockchain. And Alchemy is focusing on providing that basic infrastructure for all developers and enterprises to interact with the blockchain. But down the line and in the future, they look to continue to provide more developer tools and APIs to really make it very easy for anybody to get started and build on the blockchain. Really, right now, they service about 70% of the Ethereum ecosystem. They are also powering like 95% of the NFT applications on their platform. And beyond that, they're also moving on to other scalability solutions, both in terms of layer 2s and layer 1s. We led the Series A. They just recently raised a Series B from Code2 and Addition, an $80 million round at a $505 million post-money valuation. So there's a lot of interest in working with and also investing into Alchemy. So we're really excited about that one. One of the first deals that I did at Pantera was into a company called Veeam. Veeam is basically Venmo for business-to-business payments, focusing on small and medium businesses, which is about a $50 billion market in terms of payments. And it's actually the section of enterprise payments that actually has the largest pain point in terms of sending money across borders in regards to sort of the time that it takes and also the fees that are incurred. So Veeam makes it really easy to send money across borders from business to business, and they do so using Bitcoin and cryptocurrencies in the back end. So making it easy from that local fiat to crypto back to local fiat conversion. And we led the seed round. They've raised subsequent rounds from Kleiner Perkins, Goldman Sachs, etc. In terms of exchanges and brokerages, the most interesting geography right now is Latin America. There's been a lot of growth in Latin America due to sort of macro and pandemic circumstances. And so in Latin America, actually stablecoins has been extremely popular for store value and for payments. Bitso is the leading exchange and brokerage in Mexico, servicing over 2 million users so far and enabling both an on-ramp to crypto, yield and also cross-border payments. They're expanding over to Brazil and already doing very well in Argentina and other geographies. So we're really excited about that one. On the enterprise side, Joey's mentioned that there are different ways to scale blockchains right now. You can build your own blockchain that competes with Ethereum, or you can focus on a project that helps to scale Ethereum. And that's what Offchain Labs does. It provides a scalability solution off of the Ethereum blockchain. And basically, it is now launched, and they are in sort of private beta working with some top companies like Reddit. And in addition to that, there's an opportunity to even create an enterprise solution for some of the larger banks to be able to use blockchain technology. So we led the seed round, Polychain led the Series A, and there's quite a bit of interest for further fundraising right now. On the consumer side of things, we do think that, there's going to be tokenization of not only what we sort of see today, but potentially other real world assets like synthetic stocks or airline miles or loyalty points, etc. And Bakkt is creating that digital wallet that allows any sort of tokenized asset to be accessible and tradable, especially on a secondary market for consumers. So this is in addition to their futures contract that they have for Bitcoin. So Bakkt is really enabling both institutional and retail adoption of digital assets and cryptocurrencies. And we participated in their Series A, and they recently went public. So that's been a really great investment for us. In addition to Bakkt, other consumer use cases that we're looking at, and I think consumers can get larger and larger, especially for this blockchain fund. We've done some NFT investments like Maker's Place, and we're also looking at some things around NFTs and gaming. And then on the finance side of things, I'm on the board of Staked, which is the leading infrastructure for staking your proof of stake assets, Ethereum being the most obvious one, but there are other assets like Polkadot and Solana that you can stake. And to do that, you have to run infrastructure and hardware. These guys do that for you. And all you have to do is delegate your assets to them and earn yield anywhere from 5 to 15%. These guys have been doing it for a long time. We've been partnered with them, and they have a pretty large initiative for ETH2 staking, which is pretty compelling. So we think that this infrastructure can be extremely valuable and needed for not only funds, but also institutional and developers building products on top of yield. I'll quickly touch on this slide. This slide is really just demonstrating that the non-Bitcoin Ethereum market share has grown from 34% from 16%. As you guys may know from our liquid token fund strategy and what we tend to do on the liquid side of things, we definitely believe in the value of Bitcoin and Ethereum, but we do believe that non-Bitcoin and Ethereum assets are likely to outperform in the short to medium term. And therefore, with our strategies, most of the fund is in non-Bitcoin and Ethereum assets for that higher upside / alpha. And you're probably wondering what is contributing to the growth of non-Bitcoin Ethereum from 16 to 34%. I would say largely DeFi, but on top of DeFi, which includes lending, borrowing, stable coins, and also exchanges, liquidity, swaps, etc., is really around layer ones. We've seen Polkadot, we've seen Solana, and we've seen other foundational projects like decentralized file storage, Arweave, and Filecoin that have really come out to market and gained quite a bit of traction. And so, that contributes to this graph, and we think that this will sort of continue, and it bodes well for our liquid strategy. So I'm going to turn it back to Dan to give more of a macro outlook on things.
Thanks. So, we have been excited about the technology like DeFi for 3 or 4 years. A lot of things been being built. But right now it's just an epic time for blockchain. The first one is, all around the world, the response to the pandemic has been off the charts money printing. In the United States, we started printing more money in June of 2020 than in the first 2 centuries of the country's existence. That has an incredible impact on things whose quantity cannot be eased. And there's a lot of talk about how, Bitcoin's up, gold's up, S&P 500 is up. Maybe the perspective is all those things are relatively constant, and it's the price of paper money that is being debased and going down in value. So we have shown here in this next graph the value of the US dollar in bushels of corn, in grams of gold, in other assets which cannot be quantitatively eased. And you'll see gold actually is one of the least good performers. It's barely gone up since the pandemic started. I actually think that is because Bitcoin is taking, and other cryptocurrencies are taking, massive market share in the inflation hedge asset class or category away from gold. And the last thought on this is we have had the S&P setting record profits during the middle of a global pandemic where corporate profits were being destroyed. Hitting record highs means there's too much money being printed. On the next slide, we have some of the famous legendary investors that have seen the value of investing in cryptocurrencies, particularly Bitcoin, in a money printing cycle. Paul Jones obviously caught the '87 crash in the stock market. Stanley Druckenmiller is one of the best investors of all time. They're buying into Bitcoin because they think it reminds them of gold. And I actually think that's why gold isn't performing as well as it would otherwise, because investors like this are buying Bitcoin instead of gold. We're seeing that on the corporate side. There's a bunch of big corporations that are investing in Bitcoin. It's always hard to be one of the first, but once these public companies have done it, makes it a lot easier to get people invested in the space. And so I wanted to talk about the trade itself. And the reason I'm excited about it is in my career at Tiger Management and Pantera, after that, it was always looking for asymmetric trades, trades where the upside's much greater than the downside. And Bitcoin blockchain is the most asymmetric trade I've ever seen. It is disrupting dozens and dozens of different markets. A few of them are shown here on the screen. And the important point is they're all by far the biggest markets on earth. Global payments, gold, wealth storage, even money. People don't think much about money in the developed world, but after all the money printing that's going on now, I think people will think a lot more about money. So what has that done in terms of an opportunity for investment in a portfolio? Bitcoin, like any disruptive technology, has an almost vertical price graph if you graph it the normal way with a normal scale. But if you graph it logarithmically, it shows actually fairly consistent compound annual growth rate. Bitcoin has grown at 233% for 11 years. Certainly it's had a couple bubbles, it's had a couple big bear markets, but over long periods of time, it really does just kind of grind up. There actually hasn't been any 4-year period of time that Bitcoin has gone down. So it's been an amazing performer over all that period. And the other reason one would want to have it in their portfolio is it has zero correlation to anything else. And that is really new. When I started out as a bond trader in the 80s at Goldman Sachs, I just thought about bonds. I didn't know anything about equities. I didn't know anything about commodities. I didn't know anything about anything else in the world. I just came in and traded bonds. Portfolio theory was so successful that we now all essentially have the same portfolio. And so when one thing goes down, everything goes down. Bitcoin is one of the only, well, it's the only $2 trillion thing on earth that has zero correlation to everything else. In 10 years, when everyone has a blockchain team and a blockchain allocation, the correlation will be quite high. But for now, it is the dream asset, 233% compound annual growth rate and zero correlation. You need to have some of that in your portfolio. Well, how do you value it? That's a question that's a fun one. One of my Tiger Cub friends said they don't trade Bitcoin because there's no cash flows to discount. And I said, well, there's no cash flows to the euro, and nobody thinks twice about trading the euro. And that's basically the way one needs to think about it. Is it is supply and demand. There are lots of data points that can give you information about the value of Bitcoin or other cryptocurrencies, but the simplest construct is an old Econ 101 style supply and demand graph. And the number of people coming into the market grows at a very rapid rate. And then every 4 years, the supply that's issued to the market is cut in half. And that has led to, and there's already a question in the Q&A box about the 4-year cycle of Bitcoin, a very strong 4-year cycle to the price of Bitcoin. About a year and a quarter before they cut the supply, the price starts going up a ton, and then it goes up very big for another year and a quarter. So after the supply cut, and then it kind of pauses for 2 years until the next big wave happens. All right, so another perspective on how to think about the value of Bitcoin is this next graph. We have the number of people using Bitcoin, and that is posted next to the price of Bitcoin. It is absolutely staggering to see a graphic that has 2 data series going up 5 orders of magnitude, and doing that every 2 years for 10 years, and doing it exactly in lockstep. There's only one time, 2016-17, that it didn't hit it perfectly. To me, that is, it's a very useful construct. The more people who want to use Bitcoin for cross-border money movement, wealth storage, whatever, the price goes up. That helps answer a question that TV pundits always want to hear: is what's your terminal value of Bitcoin? And if everybody with a smartphone started using Bitcoin and this relationship held, it would hit 700,000 at some point. And again, I'm not sure exactly where it's going, but that's at least a decent, kind of order of magnitude scale of where it could go. All right, the last argument in favor of Bitcoin from a portfolio management standpoint is one of the most common reasons to be worried about whether one should propose crypto to their investment committee is it's too volatile. And admittedly, it has 70% annualized volatility, it's very volatile. But the really, really important point is almost all the volatility is on the upside. This next graphic shows that even with all those crazy bubbles and crazy bursts and 85% bear markets like we had just in 2018, we've had a ton of big bear markets in this industry. We just had 55%, a couple months ago. It's only printed one lower low, so there's only one calendar year where it's printed a new low. So it really is an amazing asset the way it's very volatile, but only to the upside. All right, so a quick snapshot of where we are now in terms of the market. A couple of weeks ago, 8 weeks ago, we had the most volatile week in the history of Bitcoin. We had a 21% trading range, and that volatility brings opportunity. There's a couple of things that really got it going. One of them is the Chinese ban of Bitcoin, and I used to air quote that because the first two bans in 2013 and 17 didn't really happen. This one actually seems real, so I don't air quote it anymore. And also worries about the environmental impact of cryptocurrency and ESG. On the next slide, we have just a very quick snapshot to try and encapsulate a lot of thoughts we shared in our most recent investor letter. But essentially, the way to think about it is ESG, blockchain is awesome for ESG. It's great. It's going to do so many wonderful things for literally billions of people on Earth. When we look back 20 years from now, I think people are going to realize it's one of the most amazing things that's ever been gifted to the world. But there's some questions on Bitcoin's energy consumption. It's high, provides an amazing social good. It's providing savings for 100 million people, and so it's an interesting question. Every other box on this grid, is pretty unambiguous. It's all good for ESG. So if you're interested in, especially if organization has any qualms about the ESG impact of blockchain, our August investor letter has 16 pages of thoughts on ESG. We did come up with a very interesting insight to me, is that the Chinese ban is really taking hold. So we did a bunch of analysis of the amount of mining capacity or electricity consumption in the Bitcoin markets, and it came off about 45% from peak to trough. Again, the biggest fall in history. 25% of that is not explainable by this polynomial regression that we've used in the past, which does very, very accurately predict the mining capacity. So some of it was because the price came down, and that makes some mining operations marginally net negative, and so get unplugged and stopped. But 25% of the entire mining capacity of Bitcoin was shut in a way that's not economically rational, based on our previous experience. So that means the Chinese really are clamping down on Bitcoin mining. That actually has no real impact on the Bitcoin ecosystem. It's still doing the same number of transactions, still same security, all that. It just means that that value, and there's $2 billion of value there, is going to go offshore from China, go to some other country. And in most countries, they're using at least 50% renewable energy, so it's probably much better for our industry. All right, so where does that leave us on price? Bitcoin has had all these wild cycles, but right now we are 32% cheap to its 11-year trend. So, people have been asking for 8 years whether it's a good time to buy Bitcoin. And I say yes, it's always a great time to invest, but this is a more attractive time than most. A very small percentage of the time it's been below this. We actually did a histogram of our own inflows into our Bitcoin fund, and the percentage of time that Bitcoin spent in each of these price buckets is here in gray. It's normally distributed, as you'd imagine, and always kind of near the trend, and then sometimes very far away, but not very often. And the gold bars are the amount of inflows we've received into our Bitcoin fund. And those have actually been very pro-cyclical. Just like everybody, when the market's at the absolute high and Bitcoin's on TV, 24/7, it's really easy to get fired up and want to buy some more. I've done it myself, and our inflows have been very skewed to when the price of Bitcoin is way above its historical trend, and then when it's very cheap, like it is minus 36 now on the left side of the graph, not that much money comes in. So it's just a reminder that you kind of have to take advantage of these big downswings in the market. Okay, so that brings us to the current fund. The current fund can do that. It can take advantage of the big swings in the market. We can invest in liquid tokens when they're cheap, like they are right now, and then over the next couple of years, when liquid tokens hopefully get back to being very expensive, we can sell those and then use the proceeds to invest in venture equity and in illiquid early stage token deals. Our fund is the terms are on the next slide, where we are targeting 600 million. It'll be about 40% in venture equity, probably 30 or so, 35% in early stage tokens, and then the balance in liquid tokens. We've already seen the benefit of that when the market sold off really hard in June. Made tokens, in our opinion, very cheap. So the fund was able to buy tokens, and then over the next couple of years, as the value of those tokens increase, we'll be able to sell those and invest in venture and essentially compound the returns of the fund. We plan to spend 12 months raising capital for this fund. Many institutions, have a 9 to 12 month investment cycle, so we will be raising money hopefully until March of next year. But we were able to do over half of the target in our first closing on July 1st. With that, I want to hand it back to Paul to talk about the fund itself.
Thanks, Dan. So I'm going to talk about the venture equity strategy and the early stage token strategy. I'm going to start off with each of these next two slides by talking about, sort of how it fits in with the larger fund and so, sort of why the allocation size for each strategy makes a lot of sense. And starting off with the venture equity strategy. So, this is going to continue to invest into early stage projects, anything from seed to Series A. But now I think as the industry has grown in terms of number of companies, it's also grown in terms of maturation. And we're starting to see some of these Series A companies mature to Series B and C rounds. As I was talking, I just saw, a growth stage round where FalconX, raised that, over $1 billion valuation. So we're seeing now hundreds of millions to billions of dollars in valuation. And we're starting to see some companies skip from C to Series B. And, for us, we want to continue to focus on the early stage, but be able to opportunistically invest into some Series B deals. Actually, a deal that is in our pipeline right now is in the, I call it sort of Series B stage, where we would be investing closer to $15 million. Outside of that, most of these deals will be in equity, and they will be focused on some of the same areas that we've been investing into, infrastructure, payments, but we'll probably see a bit more on consumer and a bit more in terms of investing into other types of infrastructure in other geographies. I think those two trends will increase a bit for this new blockchain fund. And if you estimate that 40% of this fund will be in venture equity, 240 million is only a slight bump up from our venture fund 3, which is 175 million. So I think we're in line with the growth of the industry. In terms of early stage tokens, we are investing into early stage projects before they actually launch their token on a centralized exchange or decentralized liquidity avenue, decentralized exchange. So the way that this looks like is the industry is changing. We are seeing smaller rounds and more rounds before companies do go public. So I would say anywhere from 1 to 2 million initial round to maybe 5 to 15 for that second round, and potentially even skipping both of those rounds and going to a $100 million round for some companies that have been centralized for a while and are thinking about adding a token to their product or company. So I think for us, like, as long as we focus on pre-launch token projects, that's kind of where the most upside will come from. Once they actually go public, usually there's quite a bit of a multiple that gets layered on top, especially during a bull market. And so continuing to focus on the first and second rounds, seed and Series A's. But we are going to see some of these growth rounds happen, especially for, let's just say, a large centralized exchange that decides to launch a token and already has a valuation that may be in the hundreds of millions to billions of dollars. And an example of that would be Bybit. We invested into the BitDAO, which is a DAO that is being sort of led by one of the largest centralized derivative exchanges in the world called Bybit. And we invested, in a pretty large 8-figure size into that investment. So there's really an opportunity to put some scale into early stage tokens. And if you estimate that 30% of this fund will be in early stage tokens, 180 million, especially where our current early stage token fund is at over $1 billion, I think we'll be able to find some great opportunities there. I'm going to send it back to Joey to talk about our liquid strategy.
So thanks, Paul. So on the liquid side, the high level is that we're going to offer actively managed exposure to liquid assets in the space, predominantly things in the top 75 or so by liquidity. That's the main metric we look at for like what's in our investable universe. And we're trying to build a portfolio surrounding the space. We do also do trades, things like trading around, BTC and ETH dominance. But I'd say outside of that portion of the portfolio, the rest of it is predominantly DeFi focused. Of the liquid token strategy, it'll be roughly 30% of the target capital raise on a $600 million fund. That would be about $180 million. And I'd say, Pantera's background in the space gives us an advantage when it comes to trading. Dan, our founder, he's the head of global macro for Tiger back in the 90s. And so, we bring a lot of that DNA and way of thinking about trading, and when it comes to, soliciting picks from people in the fund on the IC, for what sort of positions we want to own, when we want to take things out of the portfolio, add new things to the portfolio. I'd say if you look at the core of the strategy, it's predominantly looking at buying things with those strong fundamentals, pretty quick growth, strong teams, adding sort of a technical overlay to that. So we like to buy things when they're, undervalued, try to de-risk them some when they're overvalued. And then there's a risk management overlay on top of everything from a macro standpoint. And I think the way to describe the risk management is we're trying to take de-risking trades we think have a really high win rate. So if you look at crypto, the analogy or story I like to use is, the best 5 days of ETH drive over 75% of the performance. So you don't want to the market too much, at least where we are now. 10 years from now, it's going to be totally different. You'd want to run a 100% long short book. That's not where we're at today. You want to be long biased. And when you do de-risk, you want to think, 7 out of 10 universes where I de-risk, the market should go down. We're not trying to de-risk when we think we have a slight edge, thinking the market might go down. And so what that means in practice is we'll catch some of these de-risking swings and we'll miss some of them. We're not going to catch every downswing in the market. And so if we go to the next slide, we can look at why we invest in certain projects. And so on the left, you can see the thesis that we mentioned at the beginning. That sort of is kind of like a cornerstone for how we think about everything else. But I would say when looking at individual projects in specific, the first 3 are actually true across all the strategies. We're looking at the team. We're trying to invest in world-class teams that can execute very quickly and consistently iterate on product. I think that's actually like the most important thing with any investment is how fast can the team move? How fast can they make changes? When they realize that something's not working, do they double down on it and keep trying to, go through something that doesn't actually make sense, or do they like iterate and modify their product to make something that actually works? So basically, what's their kind of velocity is sort of the main thing. The other thing that's really important in crypto is community, because crypto projects have really sizable communities, and user engagement is pretty proportional to how large the community is. That's how you're going to build awareness, especially in a market where there's thousands of cryptocurrencies, and you have to have something that gets you differentiated. And so like one way to differentiate is on product, but another way is if you have really strong community builders as part of your team. great example of this is like if you look at, Chainlink, like their community is massive, um, and so community is really important in crypto. That's why, like, I think Ethereum won and got so much traction and developers building on it. There were a lot of people trying to build smart contract platforms. Ethereum obviously had a pretty good product, but it also had a strong community of developers around it, and I think that's really important. The third thing is valuation. So, we're not the type of investors who would, buy something at a really crazy price because we think it's attractive otherwise. Instead, we're pretty valuation sensitive. We like to pay, fair prices for deals or things that are pretty close to fair price. Obviously, we don't try to over optimize on valuation. If something's 30% too expensive, we might still do that deal because we think it has really high upside in the long run. But we wouldn't pay, multiples of what a company's worth in FOMO into it. That's not really our model. And then the very last thing, which is more specific to the liquid token fund on the trading side, is technical analysis. This is looking at data to try to predict how the price might change on a shorter time horizon. There's two things we use this for. One is for when deciding, we have a list of positions that we think are attractive at any point in time. But if they're unattractive from a technical standpoint, we might hold off on buying them. So that's one scenario. The other scenario is kind of for the more macro de-riskings of the portfolio that I mentioned earlier. We use technical analysis to try to decide whether we think the market has, broken some fundamental trend or whether it's regained support, above some key support threshold where the market can then resume upward and is bottomed where we'd want to buy back. And Paul's going to talk about our edge.
Thanks, Joey. So, when people look at Pantera and choose to go with us, I mean, there's a few different things that they look for. Number one, it's the team, working with the partners and everybody else surrounding us, having one of the larger teams in the space, I think now approaching 50 people. We really do have expertise coming from Wall Street, technical expertise to be able to dive into scalability and how they should think about their architecture, security, et cetera. And then, experience around business operations, venture, and even sort of middle and back office, which can be helpful around how to position themselves to launch new types of products that would be attractive to retail and institutional investors. So, the team really collectively goes out there and provides value. And, we've even sort of structured ourselves to have a platform team, head of platform, a director of recruiting, and we're going to continue to hire to bring in-house a lot of the value-added functions around community and governance that are sort of necessary for token projects, especially to really sort of succeed. And so, really kind of bringing a services model and, pairing that up with sort of the infrastructure that we have to, execute on the trading aspect and even use a lot of the products and projects that are out there. And sometimes those lead to investments such as investments in prime brokerages, exchanges, custodians, where we are users of those products and can provide a lot of feedback and a lot of business development and traction for those guys. And it leads naturally to us wanting to have a little bit of investment and skin in the game to make sure that both parties are aligned. Outside of that, I mean, we're continuing to find ways to scale our network, making sure that, all of the thought leadership and all of the connections that we've made within the last 8 years can really benefit our portfolio companies. So once a company enters our portfolio, they can easily network with other portfolio companies, but we're making sure that they can network with other VCs, other potential government agencies, enterprises, whatever is needed to really help them sort of scale on the recruiting and business development portion. In terms of deal pipeline, you can see that our deal pipeline has been very healthy and actually growing quite a bit, especially this year. Really just seeing that the top entrepreneurs in technology in general are coming to blockchain. I'm seeing a lot of my friends in traditional fintech and technology companies wanting to start to build on blockchain because of the the infrastructure that's being put in place, scalability, and the financial opportunity and disruption that could be had. So when a lot of the VC firms are seeing that the top talent in their portfolio across all different sectors are looking at and moving into blockchain, we're seeing more deals than ever. We're seeing a bit more on the token side versus the equity side, but actually, I think we're going to see a rise back up in equity, especially as we start seeing more consumer use cases happen. In terms of things that are in the pipeline, I would say that we're looking at companies that range from optimizing yield on platforms like Uniswap to uncollateralized lending to regulatory technology, which I think will be more and more important, especially as fintech companies scale and reach the mainstream, and especially around crypto use cases and around sort of what's going on with regulations and knowing your customers and AML and fraud detection. And we also are looking at things around mining too. The last slide that I'll talk about will be around our loss ratio. So as you know, in venture, you have maybe 35 to 40 bullets in a fund, and you're hoping for one to a few winners, and there's going to be a lot of ones that just go to zero. Surprisingly, but maybe not so surprisingly, in our first two venture funds, we've had winners and our returns are phenomenal, but our loss ratio in terms of losing money on deals has been quite low. So in venture fund 1, it's only been 3%, and in venture fund 2, it's 10%. So combined, our loss ratio is 8%. And we don't have venture fund 3 up there, but it's because it's actually at 0. I mean, we haven't lost anything in venture fund 3 yet, and it's been around for 3 years. And many of our companies have raised subsequent rounds at much higher valuations than their previous rounds, especially the ones that we got in at. And I think the reason for this, number one, is that we're great investors. But outside of that, it's really because we're in a cutting edge industry that is still very early on, and the biggest hurdle to scale right now is talent. And so as we are investing into what we think are amazing teams, and that's the number one criteria, like Joey said, when these projects don't pan out, we can at least sell these companies or teams for at least their cost basis. And then of course you layer on the technology that they've built, the traction, the product, and other sort of business development relationships, and that leads to sort of higher than cost basis in terms of our exit. So, we think that this should continue for a bit, and we do our best to stay on top of our companies and make sure that they can find a home, whether it is an earlier exit than what they expect. I'm going to turn it back to Joey for performance highlights.
Thanks, Paul. So on the on the performance side of things, looking at our venture funds, our fund 1 was a 7x. These are all net total value to paid in. Our fund 2 is a 4.7x, and our fund 3 is a 6.4x. I'd say our fund 1 marks are probably pretty mature. Our fund 2 still has companies that are still going, where they think the fund could end up returning more capital than that. And then our fund 3 actually isn't even that old. We've basically just about finished fully deploying it, and we raised it in 2018. So as far as venture funds go, it's actually still relatively young. So my view that the multiple will go up even further over time. Switching over to our hedge funds, I think if you look at our hedge funds, one way to look at them is look at their life-to-date returns. So if you start with a Bitcoin fund, which is the first fund we launched, that fund is up 61,775%. Or if you look at it in terms of compound annual growth rate on an annualized basis, it's about 121%. Our liquid token fund which we launched, as Dan mentioned, that's the one we launched sort of right at the peak of the market. Its growth rate is about a 48% compound annual growth rate, life to date return 334%. And then our early stage token fund investing in early stage deals on the token side, life to date return 1,081%. And its compound annual growth rate, if you invested on day one, is 82%. And one question we get is, okay, why shouldn't I just buy Bitcoin, or why shouldn't I just buy ETH, or why should I just buy a basket on Coinbase? And I think that's totally a great first step to getting involved in the space. But we do think active management can add alpha. And if you look at performance year to date, you can see Bitcoin is up about 52%. Our early stage fund is up about 209%, and our liquid token funds up 261%. If you look at back to January 1, 2020, sort of, roughly when the bull market started, early stage funds up over 1,600%, liquid token funds up 1,050%, and Bitcoin's up 399%. So, investing in funds, I think, can definitely add alpha over just buying Bitcoin, or even just buying, an index. Year to date, they're not on the slide, but our funds are also outperforming the Bloomberg Galaxy Crypto Index as an example. From the risk management side, I mentioned this a bit earlier. I think there's like three things that we look at from a risk management side, though. We try to really only reduce risk when all three of them align, so that we're taking trades with really high upside. And so the three things are, sentiment data, on-chain data, and technical data. And on the sentiment side, we're looking at things like number of followers to exchange accounts on Twitter, Google Trends, that sort of thing. It tends to be more confirmatory. Like, you can't really use it to predict where the market's going, but it can definitely predict or can show you what regime you're already in. So if you're trying to see, is this sell-off just a temporary thing, or is it kind of more going to be for a period of time while you look at exchange followers to Twitter, onto their Twitter accounts? And there's a big drop off there, like it might be a bit more of a prolonged sell-off than a temporary one. On-chain data, we're looking at things like how much gains are the average Bitcoin holder sitting on, basically looking at their unrealized profits. Because if you imagine, say the market sells off 20% and the average Bitcoin holder is sitting on a 4.5x gain, they might say, okay, actually, I want to lock in some of my gains. So they sell more, which causes kind of like this recursive selling in the market. And then the last category of data is more technical data. We look at things like, when people put large kind of margin positions on exchanges. We look at things like, what's the open interest in futures markets? So how much leverage is in the system, basically, what funding rates are. When the market tends to be at a kind of a local minimum, you see funding rates flip. Basically, it inverts and goes negative. You get paid to go long. And when funding rates get really expensive, when it costs a lot of money to go long, you tend to be kind of near a local maximum. And then the other type of technical data we look at is more things that you look at on charts. So trying to see, where the market is. Is it overbought or oversold? Is it above or below, current trend support? If it drops below trend support and then the next trend support is, much lower, it's a pretty good chance that the market's going to at least try to hit that trend before bouncing back up. So we try to use those sorts of things to increase the expected value of any given trade that we would do. And so that's basically an overview of how we think about managing risk. And with that, I'm going to pass it back to Dan to talk about the last few things.
Thanks, Joey. So, hey, wanted to talk about the fund structure. The way to think about it is you're going to obviously continue managing our evergreen hedge funds, the Bitcoin fund, the early stage token fund, and the liquid token fund. However, we have finished investing venture fund 3. So this new fund, the blockchain fund, will be all new venture deals going forward. And so it's the only place we put new venture deals. However, we will split early stage tokens that we do between the two funds based on their assets to be invested. And then we'll also split liquid tokens that we invest in. As Joey mentioned, the liquid token fund has done quite well. Most of it is from asset selection, but we do some quantitative trading in the liquid token fund that trades literally every hour, so that will not be replicated in this new fund. The fund is set up to be mainly like a venture fund, so it's a 10-year life. Commitment is made up front, but not all the money is called, like would be the case in a hedge fund. What we have done is to set up all the capital calls to be at the end of each fiscal quarter to make that much easier for our investors to plan. And then also, we have a number of our current LPs that want to maintain exposure to this market, because in 2 or 3 months, the market can move an amazing amount, like it has just in the last month. So we set it up so that and then we'll have December 31st, and then hopefully March of 2022. And that allows investors that are currently LPs to move from one fund to the other fund. The way it was set up is 25% of the capital was called in the first capital call, and we'll do roughly 15% for each of the next quarter. So this next capital call will be 40% of the total commitment. And the fund is set up such that it is like a venture fund. We will only recycle 20% of the exits in venture during the investment period of 5 years. Any capital will be returned to investors above that. And then on the token side, if we invest in an early stage token and it goes public in the first 5 years, we can invest it back into new early stage tokens. And what we've seen from our existing venture funds is we have typically returned capital after 3 or so years. And then around year 5 is when multiples of capital will start coming back to investors. And it's likely to be the same here. That is the terms of the deal, the fund. We're happy to answer questions. We have raised just a little bit over half of the target in this first closing. We certainly want to keep it open for the next period. And with that, we want to answer some questions. There was one that I'll take first, and then others can take questions. Is crypto crashing if any stable coin is found to be deficient in collateral? Obviously there's worries that Tether is not fully collateralized. Tether itself announced a year and a half ago or so that they weren't fully collateralized, or they were collateralized by things like cash and also IOUs, the founder. And so it's sometimes a story that it's going to cause the markets to have some huge meltdown, because an enormous amount of crypto using stable coins. But the thing to remember is the way to get money from one country to another country, or an exchange here or there. And once you've actually done that and you've bought Bitcoin or Ethereum or whatever you're going to buy, it actually doesn't really matter if Tether went to zero, because you already own the Bitcoin. So I think that the stablecoin market is not likely to destabilize the general crypto markets. And the other point to make is I think Tether probably is making efforts to kind of make up any shortfalls they have, and they've dealt with the New York State Attorney General. And so to the extent they are a problem, which I don't know any more than anyone else would about that, I don't think it has any kind of systemic impacts on our market as a whole. And with that, I want to make sure, I think we have, there's a question about whether we invest in smaller VC funds. We don't. 13% of our fund is venture funds investing in Pantera. So it is very popular for funds to try and get educated on the space and potentially co-invest with us. But we haven't invested in other venture funds. I think we see basically 99% of deals out there. And Paul and Joey did a great job talking about how we compete with other firms and what we have to do to win deals, which we don't win every deal. I think we do see every deal, so there really isn't a reason we would need to or want to invest. There's also a question about the 4-year cycle of cryptocurrencies. It's now becoming a thing. People talk about it like it's obvious. And I would say 2 things about that. Is one is so obviously we all know it. Why is it going to happen again? Is one way to say it, and the other is it's actually happened very strongly in the 2016 having, in the 2020 having. And so I have to come out in the middle on that, there's a great line by Warren Buffett about the efficient market theory, that the market, Malkiel's, theory that everything's always totally efficient. But there's a big difference between always and often efficient. And here, I think the 4-year cycle is very powerful, but I'm not sure I bet it would keep happening forever. And the question about time frame for crypto to disrupt digital payments and gold, that's a great question, and I really love it. Digital payments can take a long time because that system isn't broken, at least for us, me, in the developed world. I'm not sure where you all are participating from, but if you are in the developed world and you have a credit card, and it's Visa, MasterCard branded credit card, it's not broken. I actually get 1% cash back. I think it's awesome. So that is probably actually the last thing that blockchain, one of the last things that blockchain is going to disrupt. And that's why we've never invested in a Bitcoin payment processor. There's been a lot of cool ones that have been attempted, but the credit card system set up in an ingenious way where the person who activates the transaction doesn't pay, or they don't know they're paying, obviously. It comes out of the bill somewhere in terms of the price they have to pay to the business they're doing business with. But it's going to take a while. Whereas gold, I think it's just happened. In 2021, gold should have been up like 50% or more. Like it should be the best performing thing on earth, and it's barely up. So I think it did just disrupt gold. So it's already disrupting gold, and it's a decent fraction of gold's market share or market cap now. A couple trillion for crypto versus 10 trillion for gold. So, I think that is already happening. Oh, and there's a question about, you get over the fear of blockchain and espouse this new tech. Love that question. And the answer would be partly, I don't know that Bitcoin's going to keep going up a ton, but I just think the weighted odds, when you look at how much could go up versus how much could go down, is an incredible expected return payoff. And I think that's where a lot of people, especially some kind of old-timey investors, really get hung up, that it's a new technology. It's only 12 years old now. It's like, it's not that old. And it's got decades to go until it really proves itself and all that stuff. But if it does work, the upside is enormous. And so, I wouldn't suggest someone put their entire net worth into crypto, but you should put a few percent into it. And a great example, I think, we're coming back to Warren Buffett again, is in 2014, he was super negative about Bitcoin, and he keeps calling it rat poison and all that stuff. And like, he might be right. Like, Bitcoin might still go to zero. I don't know. Like, it's a very speculative investment. But if it goes up, it's going to go up an enormous amount. And he was first negative when it was at $200, and now it's at $40,000, right? So if you want to be negative or down on it, you have to be like really, really right, because it has so much upside. And in my days of looking for disruptions, like I went to Russia when Gorbachev was still the premier, looking at privatization and Argentine farmland, all these kind of wacky trades over the years. This one's just so much bigger and impacting so many different markets and so many things. Voting rights, refugee aid. There's just so many ways the blockchain can be important that it seems like you should have a couple percent of your portfolio in it. And again, could go to zero, but it might keep going up. I mean, it's average tripling every year for 11 years. So there's just no other asset like that. And the hardest question of all is what's our expected return? Joey did a great job talking about our existing funds and how they've done. This is a blend of all those strategies. So I think it'd be kind of like a blend of those returns. There would be a theoretical argument that, wow, maybe blockchain's already happened and, returns will go back to some kind of risk-free rate or some kind of normalized rate. I think we have like another couple decades to go. I mean, I think we're very early in this. People often say it took the internet 20 years to happen. The internet's 50 years old now, right? Like TCP/IP started in the 70s, and it's still producing incredible returns for internet companies. So I think you can see a long time for funds to keep having similar performance. And there's other great firms in our space. It's not like Pantera is the only one, but people in the blockchain ecosystem, I think, are going to still be able to have, really outsized returns for at least another decade. I mean, I think it is a long, long time.
Yeah, to add on to Dan's point, one way to think about how far we are in that journey is how large is DeFi relative to traditional finance, and there's tens or hundreds, depending on how you measure, trillions of dollars of assets in traditional finance. DeFi only has 100 billion, so there's many orders of magnitude of growth left to go, I think.
Joey, do you want to answer the quant question of the quant alpha in liquid token, or do you want me to?
Yeah, I can take it. So the question is, how much of the alpha in the liquid token funds due to the quantitative component? Yeah, I'd say roughly 10% of the fund is the quant portion. I haven't run like the exact attribution data in a while, so I don't have that off the top of my head for like the last quarter, but it's roughly 10% of the fund. So if you look at it from like an alpha standpoint, and then if you think about like how does that relate to the blockchain fund, well, the blockchain fund's not going to have the quant portion. It's just going to be the discretionary portion. And so, I think the question is getting at, is the performance still going to be as good in the blockchain fund because it doesn't have the quant portion? And the answer is yes, because most of it is discretionary right now anyways. So hopefully that answers that question.
Thanks. And with that, I think we've answered all the questions that have been posed. Certainly happy to take other questions via email. Shoot them to ir@panteracapital.com, and our investor relations team will route it to one of the investment team members. We'll get answers back to you. Thanks so much for participating.